So this is our section on understanding economics, and as I promised, we're going to revisit the Swiss franc being unpegged from the euro and the enormity of what has just happened. People don't realize how these things, it sets off shockwaves that will reverberate around the world for probably a few years. It'll reverberate in Switzerland for maybe decades, who knows. But it's going to be fairly chart heavy, and then we will go into some monetary history, but I'm going to show you how something like this can cause countries to collapse. So this is a chart of the Swiss franc. This is a 1 week chart, and what you see here is that on the 15th it just slammed right up as soon as they ended the peg. It went from 1 Swiss franc buying 0.83 euros up to over a euro. And that is an enormous move for a single day. But I'll take this out for a month, and you see how neat the peg was here. And then that sudden change. Here's a year, here's 2 years, and then when I go out 10 years, you'll see before the peg. And what I want to point out here, there's the crisis of '08 that happened, and then the European Central Bank started their QE and stuff, and the euro is basically being devalued against the Swiss franc. So this is the Swiss franc gaining in purchasing power on the euro. And it went through this enormous dip here and started to bounce, and then they decided to do a peg. And this peg has economic consequences that are enormous. They're artificially suppressing the purchasing power of the franc here, and what that does is it makes Swiss goods cheaper in foreign markets and makes foreign goods more expensive in Switzerland, and that causes a trade surplus where the Swiss will sell more goods than they import. But when they do this, they're basically subsidizing exporters. They're subsidizing manufacturers in Switzerland and exporters, and they're punishing importers, because an importer's goods are going to be artificially expensive in the Swiss economy. And that line of the revaluation, that's right on the end here. I don't know if you can see it on this screen, but it goes right up to the top of this 12-hour box. Had they left this alone and had the free market taken care of it, what you would have seen would be a bunch more adjustments like this, and over this 2.5-year, 3-year period, businesses would have been able to adjust to this. But what they've done here is by suppressing this and subsidizing exporters, those companies have done capital expenditures, they've invested in equipment, they've hired too many employees for the current situation. A lot of them were right in the middle. They made plans for all this growth that they were getting from this artificial subsidy, and now their entire world has changed. They have too many employees. They've got to lay off a bunch of people. They might go broke because of these capital expenditures they made on equipment and purchases. This is an enormous thing that is going to reverberate. Their economy is about to get a whole lot worse. There were companies that were importing goods where their goods got too expensive in Switzerland because of this peg, where they would have been balanced out by now if the free market had taken care of it. A lot of those companies went out of business. They had to lay off people. They had to downsize and move into smaller facilities. They had to cut the amounts of inventory they carry. Well, now they're the ones that will benefit from this, but they don't have enough staff, or they went out of business during this period because the government was punishing them for being an importer. They didn't allow the free market to automatically set things in equilibrium. The free market would have balanced all of their economy against the stupidity of the European Central Bank had they just left this alone. Plus, it requires an enormous amount of currency creation. I showed a chart in November or December Wealth Cycles report of the base currency in Switzerland, and theirs is far worse than the US base currency. It goes up, and then it goes up by a factor of about 8 instead of a factor of 4. So they've had, compared to the original quantity of base currency, they've printed far more currency on a percentage basis to try and maintain that peg. Now they've had to abandon it. And what this brings us to is the effects that this could have around the world. I know this is complex in a lot of charts, but there's something really big here, and I want to show you the ramifications of the Swiss having pegged their franc to the euro, and then the free market beginning to overwhelm that and them making the decision to unpeg. I want to show you how that relates to monetary history. Back in 1997, something very similar happened when the Thai baht was unpegged and allowed to float on the Forex exchanges. They had pegged their currency several years earlier to the US dollar, and they maintained that peg, but then pressures built up. The peg was unreasonable. It was causing trade imbalances that could not be sustained and causing a boom in Thailand. And speculators saw the opportunity here and started shorting the baht and the Thai baht, and eventually this overwhelmed, the free market overwhelmed the manipulation, and when the government was forced to allow the Thai baht to flow freely, there was an enormous devaluation. This is the how many Thai baht 1 US dollar will buy, and they were at about 25 Thai baht, and then they unpegged and it shot up to over 55, and then you have this absolute chaos in the next few years, and then it started to stabilize in about the year 2001 and started a little bit more orderly revaluation. But that kicked off a chain of events. If you go to, there's a link below this, and please go there and take a look at this timeline. This is from Public Broadcasting, PBS, and from one of their frontline specials called The Crash. And it starts in May of 1997, and basically that Thai baht revaluation caused a stock market crash in Thailand and caused a banking panic, which then spread into other countries, neighboring countries. It was called the Asian Contagion. And this is the exchange rate of the currencies. We've got the Thai baht, the Indonesian rupee, Philippine peso, Malaysian ringgit, and the South Korean won. And June of 1997, July of 1998. So this is just 1 year. And this is the change in the values of their currency. The Thai baht fell 40%, the Indonesian rupee fell 83%, Philippine peso 37%, Malaysian ringgit 39%, and the South Korean won 34%. South Korea had to be bailed out by the IMF, and you know, when they basically, the IMF looked at it, all their currency reserves were gone. They were just about insolvent. But what's amazing is if you look at the same chart, but you substitute, instead of their exchange rates, you substitute the gross national product. So the size of their economy shrunk almost exactly the amount of the exchange rates. Thailand down 40%, Indonesia down 83%, Philippines down 37%, Malaysia down just about 39%, and South Korea down 34%. This actually caused problems that reverberated around the world and caused Russia to go into a bond default, the Russian default of 1998. So that happened in July of 1998, and that caused a hedge fund in the United States, out of Connecticut, I believe, called Long-Term Capital Management, to go under in September, just a few months later of 98. And Alan Greenspan had to arrange a bailout, and this doesn't sound that big these days. It was $3.6 billion. So this didn't measure in the trillions. But this little hedge fund had to be, Alan Greenspan had to get a whole bunch of the world's largest banks to agree to buy this bankrupt hedge fund and liquidate all of the assets and make things right. And we actually came within hours of the entire world financial system freezing up and interbank lending stopped stopping, and that would have caused credit cards to stop working, which then means the gas doesn't come out of the pump, you can't get groceries from the grocery store, and eventually the water stops coming out of the tap. The Swiss franc being pegged, any peg, is a bad idea. It's a small group of people thinking that they are smarter than the free market, having the hubris to think that they have more information than the market, which has the information of every single transaction in a society. When they try and control things, it always ends up causing energy to build up. Now think about the energy that has been built up from China pegging their currency for decades, and what'll happen when they blow up. But the Swiss franc is, depending on the year it's measured and the data, it's somewhere between the 5th and the 7th most traded currency on the planet. The Thai baht is like 37th. When the Swiss franc unpegged on the 15th of January 2015, immediately, 2 brokerage houses had to fold and file for bankruptcy the next day, and then the traders that are in it. The traders are charmed by leverage, and the currency markets offer enormous leverage, 10 to 1 and greater. So you can put $10,000 in a brokerage account and trade $100,000 worth of currency. Well, when there's a change of 20% like that, your change in your account is 200%. And so now you're insolvent. So these traders are going to be losing their homes, their cars, their life savings. And the brokerage houses that went out of business serviced more than just the people that were speculating on the Swiss franc. And so, you know, back when we were filming Hidden Secrets of Money, when we started filming it, we did the opening sequence, and in there I said, we're entering a period of financial crisis that is the greatest the world has ever seen. And that is happening today. These shockwaves that could cause this could cause another Russian revolution to happen. We have no idea what's going to happen, but the shockwaves of all these things, the deflationary pressure, the Russian crisis that's going on, commodities falling, and then the Swiss unpegging from the euro, all happening at once. And by the way, there's bank runs happening right now in Greece, and 4 of the largest banks in Greece have asked for assistance from the European Central Bank. So this is all happening at once. What I think is going to happen is this will smooth out for a short period of time, but then it's going to get worse again. So these shockwaves, this all undermines the trust in central banks and the trust in fiat currencies. The Swiss franc had more than a 30% swing settling in just one day on being 20% stronger than it was the day before. And another thing that I didn't talk about is they were already paying 0.25% negative, not paying, but charging 0.25% negative interest rate to the banks that have to have deposits with the Swiss National Bank so that they can do fractional reserve lending. Without having currency reserves on deposit at the Swiss National Bank, they can't do their normal business of lending currency to people. Well, they increased that negative interest rate to 0.75%, so 0.75% that the banks have to pay to the Swiss National Bank just to have a checking account, to have something on deposit there so that they can operate their businesses. Now, if you had talked to anybody in the banking sector any time in history before 2008, and you tried to talk to them about negative interest rates, they'd be going, what? They would not be able to comprehend what that was or even how that would work. This is desperate. The central banks are now backed into a corner, and everything that I've been predicting is starting to unfold here. It's unfolding very slowly and on a scale that's huge. But it's not going to be slow forever. There's going to come a day where slow turns into very fast. And a lot of this stuff happens overnight. For instance, the currency unpeg. Nobody knew it was coming. It happened immediately. And so these things always end up eventually being good for precious metals. I don't look forward to the economic chaos that we're about to go through, but we'll get through it, and it'll be a different world when we come out the other end. Hopefully, what ends up happening is free enterprise, free markets, capitalism, and sound money win. That would be the best outcome. Thanks. When Lehman Brothers melted down, did you find out about it before it happened, or did you find out about it after the Federal Reserve and the Secretary of the Treasury and everybody got together and came up with a solution, and it was already dissolved, and other banks had Bear Stearns and Lehman Brothers? I mean, what happens is there's an emergency, and a very few people keep it secret, and they try and solve the problem, and then you wake up in the morning, problem solved. Well, what happens in a currency revaluation is there's an emergency going on behind the scenes. The public doesn't know about it. A few people get together in a room and they decide that the solution